What is going on, guys? Your everyday options trader back here with yet another video. Today I got something a little different for you. So mostly I do focus on short-term investments. However, in this bear market that we are in, it is much harder to make gains for the long term and something to fund your investment portfolio and give you consistent income while you're trading. Though you may be losing, you also need diversification. So in this video, I'm going to be discussing 5 stocks that I personally hold that pay me dividends, whether that be every quarter or every month, and that I personally do like a little bit more than the other monthly and quarterly dividend payers out there because of their higher yields. Now, keep in mind with these, they pay larger than normal dividends, which means something north of 5%. So they're not really going to experience a lot of share price growth. These are more for income, right? So you're not going to see a lot of portfolio appreciation or depreciation. However, you'll constantly be getting those monthly and quarterly checks from these stocks, and that's going to help you either pay your bills, fund your investment account, or just give you spare cash to set aside. Or the best way, obviously, is to reinvest those dividends. That way you can compound those and create more. So, getting right into it here, the first one, which I'm sure many of you have heard about here, is a covered call ETF. Now, basically, what that is the fund sells covered calls in order to pay their dividend. Now, of course, here on the Everyday Options Trader channel, you know I would not make a video without it somehow, some way, some form involving options here. So we have not one, but 2 of these covered call ETFs that I really do like, and their dividend pays are extremely strong. So this first one is going to be QYLD. Most of y'all, I'm sure, have heard about QYLD here. Now, this is the Global NASDAQ 100 Covered Call ETF. Now, basically, this one sells covered calls on the NASDAQ, or the triple Q for those of us options traders. And we all know that they do have a lot of volatility, so it's very impressive to see something like this come around where there's a lot less volatility. Now you can see our year-to-date total return on this is down 19%, but you factor in the dividend yield over that year, and you're actually only down about 6.5%, 6.5, 7% basically. So that being said, the S&P 500 right now, or well, shoot, yeah, let let's just take a look, or rather, let's look at the Nasdaq since this is based off the Nasdaq. The Nasdaq for the year is down a lot more than that, somewhere around 50%, I think it is. Wonder if it'll tell me. Okay, yeah, 30%, right? So would you rather be down 8% or 30%? So that's something to keep in mind as well with these. And if you were reinvesting the whole time, it's probably just a couple of percent. But now, oh, back to the Forex. Okay, so back to this one. Got a little sidetracked there. So you can see the NASDAQ is down quite a bit. We'll go back to QYLD here. Now, QYLD over the past year, you can see it does somewhat mirror the NASDAQ. However, because of those dividends, that significantly decreases any market loss. Now, these covered call ETFs are a little more volatile than the last 3 that I do have. However, you can see it pays a 13.14% dividend yield, and that is very impressive. And this one pays monthly, so you would get basically 1.2-ish% of your money every month. Every month you would get 1.2-ish% of your money. It's like 1.1 and some change, but we'll say 1.2 for video's sake. And the plus side of the market being down so much is that you are basically buying this for a 20% discount, right? So if you bought it today, obviously the market can't go down much more than it already has. But even if it does, it's still going to pay a higher yield on those shares, right? Because it's a percentage basis, right? So you get 13.14% of 15.75, more or less. So you're getting whatever that is. As the price goes down, dividend yield goes up, right? So it becomes cheaper to buy in as it rides back up, which is really good. So something to keep in mind with this one. Now, QYLD is the oldest one. It has been around for quite a while. You can see on the 5-year return, it was pretty flat up until, of course, the whole end of 2021 when the market did start to collapse. But you can see it's still not as down severely as the NASDAQ. So that is our first one we're going to be going over today. Of course, QYLD is a great stock that I own myself, simply because it does involve options. And hey, who can argue with 13.14%, right? The next covered call ETF I have is XYLD. So this one is the lowest yielding of the three. This one actually is now paying more for some reason, but hey, whatever. So you can see here XYLD, the yield 13.48, year to date total return down 12%. So this one is based off the S&P 500. Of course, this one is a little newer, but you can see it is much flatter, much safer. I do like this one just a little bit more, because it pays just a little bit better and it's a little more stable. But again, 13.48%, who can argue with that? Really great covered call ETF. Again, these are the ones that sell covered calls against the S&P 500 and generate the dividend from that. So long as they're selling those covered calls, which they always are, you're generating income. All right, so the next company I have here that is not a covered call ETF is a company called Gladstone Capital. Ticker symbol GLAD. Now this one is a BDC. Basically what that is they buy and acquire businesses and finance them and do all kinds of things in the business world, basically. And that allows them to generate profit. Now, I believe it's 80% or maybe it's 90% of their profit that they make from these deals, they have to give back to investors. So you can see we have a really nice high dividend yield on this one of 8.93%. You can see that it is actually pretty decent stock on the 5-year, very flat, very good looking here. You did have that one dip during COVID, but you can see unaffected by the market now, and it's just done very well. Stayed around that $10 range the whole time, with the exception of COVID, which obviously everything was shut down, so there were no deals being done. We're going to call that as an outlier there. And you can see it did quickly recover and stayed around that basically between 11 and $9 range. So that one is pretty good. They're a very solid company. They have very good financials. They also have one other or two other ones as well. Ticker symbol good, and I can't recall the other one, but they are all under this Gladstone name, and they are pretty good. They have a REIT as well. And then I believe their other one is also, it's like a REIT BDC hybrid. So that's pretty cool. Now, another one I've got here, I do have a REIT in here, and that is GNL. So GNL is Global Net Lease. Global Net Lease does basically REITs. They lease to primarily businesses in all different sectors, and they are very solid as a company. They've not had an occupancy rating, which is very important for these REITs, below 95% in the past 20 years. You can see their stock price does stay pretty stable. It is kind of at a discount right now, but you can see majority of the time it was somewhere around that $20 range, but we're definitely buying it at a discount now. Of course, most of their leases that they hold are very long term, so that does help with this as well. And of course, it has a 13.09% dividend yield, which is again just over 1% a month. That's paying you very well. And you can see the stock price is very flat, a little bit of depreciation and appreciation in here. But again, getting paid 13% a year to hold this stock. So even if you lost 10%, you would still net 3, which is way better than anything else that you could hope for. It's almost a credit card at that point for what it's paying you. So you can see here, and we'll go back. Now I have one more BDC that I do hold, and I really like this one as well. And that is ticker symbol AC. Oh, if I can type today. It's Aries Capital. ARCC. Forgotten R. Ticker symbol ARCC. So Aries Capital is another BDC here paying a really high yield. That one is 9.81%. Now, Aries Capital focuses more on the big business aspect of it. So they are acquiring and doing deals between larger entities. Now, you can see their stock price is extremely flat with, again, that one dip in 2020. We're going to count that as an outlier because BDCs were not doing any business because everything was shut down. So you can see it has recovered quite quickly, and we're staying around that $19 to $22 range. So that stayed pretty smooth. A little bit of share price appreciation over time, which is good, but overall nothing too drastic short of the COVID pandemic. However, if you've held this for a long time at that 9.81%, you are outpacing pretty much everything as far as that goes, and the compounding as well is amazing. So those are the 5 dividend paying stocks that I personally hold and I do very much like, because with these all averaged out and combined, I'm getting somewhere around 9.5% a year, right? So that is way better than the savings account. That is way better than most ETFs as far as annual return on average. And this is pays every year without fail. Um, so compounding this in, you can very, very quickly grow something at 9.5% a year because you're paid monthly and quarterly with this. And if you're compounding every time you get it, it's actually way, way more than 9.5% per year. If you're compounding it, it'd probably be somewhere around 15 to 20% per year, depending on what you have and how quickly the market moves. As always, guys, leave any questions for me in the comments there. Thank you for tuning in and enjoy the rest of your day.